All right, now we're going to move on to the B, which says prepare the statement of financial position as at 31st December 2024. So that one is also for 10 marks, but that one is a bit easier than the income statement. So it's not so lengthy as compared to the income statement. All right. So for the statement of financial position, the first thing you write is just like the previous one, the name of the business, which is Adom Enterprise, right? So you write the name of the business again. So Adom Enterprise. Then you underline it. Then they say you should prepare the statement of financial position as at 31st December 2024. So the next thing you write is statement of financial position. It's not straight. Let it calm down a little. So the next thing you write is the statement of financial position as at 31st December 2024. As at 31st December 2024. Then you underline it. All right. So that's the next thing you do. Then now, after you are done, the next thing you do is that you write three things. Costs. So let me do it somewhere here. So costs. Then you rule the line. Then you have accumulated depreciation. So I'll just write ACC, then depreciation. So accumulated depreciation and the net book value. So I can just do it NBVIN, but the full name is net book value. You get it? So those are the next three things you do. Then the next thing you do is that you write your currency sign like the previous one. So Ghana cedis, and another Ghana cedis. So remember you are going to earn marks for this. You get it? So let me just rule a line so that you can see it better. Then you can also rule a line here. All right. So yes, but in your book, you're already going to have lines, so you are not going to rule the line. You get it? I'm only ruling lines so that you'll be able to see it. So that in case it's slant or something, saying there are no lines here, you get it? All right. So that's the next thing you do. Now, if you really want to understand this, you have to know the accounting formula, the general accounting formula. And the accounting formula says that, so this is not part, I just want you to understand it. It says that assets is equal to capital plus liabilities. So A is for assets, C is for capital, and L is for liabilities. You get it? So assets is equal to capital plus liabilities. So this is the general accounting formula. What does this mean? It means the assets I have in my business is equal to the capital, which is how much I raised. You get it? Plus the liability. Liabilities are like what people give to you to fund the business, and you have to pay them back. You get it? So the loans that people give you to fund the business and all that, that's liability. So my assets, my business actually funded by my own money, and the liability that I'm owing, the one that people give to me to fund the business. That's what it means. Now remember there are two types of assets. We have non-current assets and current assets. So the assets can be divided or can be broken down to two, non-current assets plus the current assets. So it's still equal to the capital. Now know that for the capital as well, if let's say I start a business with, let's say, 10,000 cedis, that's only for the capital. I start with 10,000 cedis, right? And maybe this year I made a profit of 5,000 cedis. Means I now have 15,000 cedis as my capital, because it's now money that I can use to expand the business and all that. So if I make a profit, I have to add it. Also, if I make a loss, I have to subtract it. If I started the business with 10,000 cedis and that year I've lost 5,000 cedis, where am I going to get the other 5,000? I have to subtract it to show that now I have 5,000 cedis. Then I have to also subtract, if I, in case I take money from the company for my personal use, I also have to subtract it. if I start a business with 10,000 cedis and I take 5,000 cedis to go and do whatever I want, I'll subtract it because now I don't have that money again. So this capital can also be broken down into, so let's see. So yes, the actual capital I started in the business plus my profits. If I make any profits, I have to add it because now I can use it to fund the business minus. And if I take money for my personal use, those amounts are called drawings. So I'll just represent it as D. So now the capital has been broken down. You get it. So now that's broken down to the capital that you actually invested, the amount you actually invested, which is the C, plus the profits you are getting. You get it. Minus the drawings, which is the amount that you take out to, for your personal use or something. So that's the capital that has been broken down. Then plus liabilities. The liabilities can be broken down into long-term liabilities and then the non-current liabilities, just like this one. So I can say plus long-term liabilities plus the non-current liabilities. I can make the non-current liabilities come here. Yes, so plus long-term liabilities plus the non-current liabilities. So what this means is that the assets which we broke down to the non-current um, assets plus current assets should be equal to this. So this part should be equal to this. You get it? So in the statement of financial position, we're just going to take the non-current asset, then we add it to the current asset, then we'll see if it is actually equal to this, which is the capital, which we broke down to the capital plus the profit minus the drawing plus the long-term liabilities. You get it? Because these are what is in the business now. We are saying that it should be funded by this or it should be equal to this. Do you get it? Yes. So now the only thing I'm going to do is I will start with the non-current asset. We go to the current asset. We go to the capital. Go to the profit. If it's a loss, we go to the loss. Then we go to the drawings. Then we go to the long-term liabilities and the non-current liabilities. That's all. All right. So having understood that, we can now start our workings. Yes, so that one is not part of it. I'll just use it to explain. So now I said the first thing we start with is the non-current liabilities per the formula I just wrote. So sorry, the non-current assets per the formula I just wrote. So we write non-current assets. So let me rule a line. So yes, now non-current assets are things it's also the same as fixed assets. You get it? So things you plan to use in the business for a long period of time. You get it? So things like buildings. I mean, if you build something for your business or you have a building for your business, you're not planning to use it for just 6 months. You're looking at 3 years, 10 years, 20 years. So get a new place. So for a very long time. So those are non-current assets. There may be machines and all that. You get it? So those are all non-current assets. So let's see if we have things like that, things that we plan to use for a very long time. All right. So now let me also show you a trick. Most of the time for the non-current assets, they depreciate. You get it? So in the question, specifically the additional information, this one like this, the additional information, the VIN, they said the enterprise provide depreciation as follows: vehicles 20%, furniture 20%. So all the ones that depreciate are all non-current assets. You just put it to your head. So this one, for the non-current assets, we have vehicles and furniture and fittings. All right. So vehicles is a non-current asset because obviously you plan to use vehicles for a very long time. If you buy a car for a business, you plan to use it for a very long time. Furniture and fittings are things that you plan to use for a long time. You don't buy furniture and use it for just 6 months or something. You plan to use it for a long time. So anytime you see that it's depreciated or they give you a value for depreciation in the question, then just know that it's a non-current asset. All right. So now here is cost, here is accumulated depreciation, and here is net book value. Now I explain. The cost is how much you bought the asset. So how much you bought the vehicle, that's the cost. The accumulated depreciation is the depreciation over the years. You get it? Every year is going to reduce value. This year, if you buy something for 10,000 cedis, next year the worth might be, let's say, 8,000. That means that's reduced by 2,000, and next year it can reduce by maybe 3,000 again and all that. So when you add the accumulated depreciation, you get the accumulated depreciation. Yes, so that's the second one. Then the last one is the net book value. The net book value is the actual value of the assets when you subtract the depreciation. So the costs, which let's say you bought, let's say for 100,000, then minus how much that depreciated over the years, that's the net book value, which is the current value. So now let's start with vehicles. Let me draw a line here so that no one gets confused. So for vehicles, what is the cost? The cost in the question was 56,250, right? So vehicles, the cost was 56,250. Then the accumulated depreciation, which is the second column. So the accumulated depreciation, you first check in the question if they're giving you any depreciation. You get it for vehicles. So let's check if they give us any depreciation for vehicles. So for vehicles, they give us depreciation in the question, which is accumulated depreciation. And the value was 11,250. So that one was not in the additional information, it was in the trial balance itself as 11,250. So you first write it 11,250. So this one is in the trial balance. Then remember in the additional information, we also solve for another depreciation. You get it? This 11,250 means the depreciation over the years, the previous years, as of the time you're recording. Then we also calculated for the depreciation for that particular year. You get it? And that was our workings for workings 5. So for that one, when we did it, we got, what did we get? We got 11,250 as well. You get it? So now we add 11,250 to 11,250. Then we should be getting 22,500. So it means the accumulated depreciation over all the years is 22,500. It's a coincidence that both of them are the same. Most of the time, it's not the same. You get it? So yeah, just put that in your head. So don't be expecting it to be the same every time. The 11,250 in the question or in the trial balance is what, or the value it has depreciated over the years, the previous years. Then the 11,250 is down. We solved for it. Remember, we actually solved for it, and we got 11,250. That's the depreciation for that particular year. So when you add it, will be equal to 22,500. Then now the net book value is the cost minus the accumulated depreciation. So 56,250 minus the accumulated depreciation, which we just solved for and got 22,500. So 56,250 minus 22,500 should give us 33,750. So 33,750, right? So yes, that's our net book value, the cost minus the accumulated depreciation. Then we go to the furniture and fittings. The cost for the furniture and fittings, which I said is what is at the debit side of the furniture and fittings, is 18,975 in the trial balance. Then the accumulated depreciation, which the one in the question, which is the one at the credit side, I said that always if you see an asset, the value at the credit side is the depreciation, is 3,795. So what is in the trial balance? 3,795. But we also remember that we calculated this 3,795 is the depreciation over the years, the previous years. We also calculated the depreciation for this particular year. That was also in our working 5. And we got, what do we get? We got 3,036. So we added to it. So 3,036. Then we get our accumulated depreciation. So 3,795 plus 3,036 should be giving us 6,831. 6,831. So that's our accumulated depreciation for furniture and fittings. So if you want to know the net book value, it will be the cost, which is 18,965 minus 6,831. And that should give us 12,144. 12,144. So yes, those are the only two non-current assets. So now the next thing we do is that we add all of them. You get it? So we add the cost and the accumulated depreciation as well as the net book value. So 56,250 plus 18,975. When you put it on the calculator, that should give us 75,225. 75,225. So here you can close it. So yes, you can just close it, showing that you're not going to do anything about it because now we are done. We're only interested in the net book value because this cost it has depreciated, so we don't use this for anything. So you're only interested in the net book value. So this one, you just close it. And for the accumulated depreciation, when you add both of them, which is 22,500 plus 6,831, you're getting 29,331. We can also close it because we will not do anything about it. Then for the net book value, which is what we're actually interested in, 33,750 plus 12,144 should give us 45,894. 45,894. This one we'll use it again, so we don't close it. You don't rule any line there. So 45,894. So now we are done with the non-current assets. We now move on to the current assets, right? So yes, now let's move on to the current assets. All right. So we check the question to see if there are any current assets. And when it comes to the current assets, we usually arrange it in order of liquidity. You get it. So we first start with the inventory and all that. Then we end at cash. You get it. That's how. So the one that is, less liquid. So the one that is most liquid. You get it. The one that can easily change to cash. You get it. So yeah. So now for the current assets, we start with inventory. So current assets are things that you don't plan to use for a very long time. They are assets, but I don't plan to use them for a very long time. So inventory like this, which are the things in the company that were not bought yet, or maybe if you are selling iPhones or something, the iPhones that have not been bought, they are assets. You get it. So they are, but then they are current because you don't plan that they will be there for a very long time. This particular year, you plan to sell it. You get it. So now we start with the inventory. And the inventory you are talking about is the closing inventory because after the opening inventory, later on they might buy it. The closing inventory, which is what is left at the end of the year, is 22,000. That one you can just record it here. So 22,000. Then the next asset is the trade receivables. The trade receivables are what people are supposed to pay you. It's an asset because it's money. If let's say someone is owing you 10,000 cedis, it means right now you can literally say you're worth 10,000 cedis because at the end of the day, if the person doesn't pay, you can sue the person. So you know very well that you get your money. So the next one is the trade receivables. So let me just rule the line here. So trade receivables. And that one was 30,000, right? All right. But before I even write the value, know that in the question, we also had allowance for receivables, meaning that the trade receivables was 30,000, but we knew very well that they don't pay us all the 30,000. You get it? And the allowance for trade receivables in the question was 938. But also in the additional information, the 938 in the trial balance means that right now at that time they had already assumed that out of the 30,000, which is the trade receivables, half of 938 that they can't pay. But in the additional information, which is the I, they said allowance for receivables should be adjusted to 5% of trade receivables. Meaning that now, instead of the 938, it's increased to the 5% of the trade receivables, which is what we did in working one. And the 5% of trade receivables, we got 1,500. You get it? So it means now instead of 938, now our allowance is now 1,500. So now we subtract it from the trade receivables because at first we're expecting 30,000. Now when you add the total trade receivables, you are getting 1,500. It means now you're no more worth the 30,000. You're not receiving all. You're going to receive less. So the trade receivable, since you also have to adjust it, we can just write the value for the trade receivables here, which is at 30,000 minus the 28,500. Or we can also show working. So you can write the trade receivables, then you can write allowance for trade receivables. So that one, since we are going to show working, so we do it at this side. So the trade receivables is 30,000. And the allowance for trade receivables is 1,500. That's the 5% of trade receivables. So we put this one in brackets, right? So 30,000 minus 1,500 should give us 28,500. So we do it at this part because that's the final value, right? Then also we have bank and cash. Yes, it's also a current asset because it's cash, money you have. So yes, so bank and cash, the value is 61,965. So bank and cash. So the value is what? 61,965. So yes, you do it at the second column. 61,965. Down with the bank and cash, which is 61,965. Now we also have another asset. The II says that rate and rent has been paid in advance by 500. If it has been paid in advance, it means it's an asset because now, I mean, you've got free 500. Your expenses were 10,500 in the question. Now they are still out to the 10,500. 500 has already been paid for you in advance. So it's now an asset. So you add it to the current assets. So we say rate and rent advance. You can just call it rate and rent advance or prepaid. Is the same thing. So the value is 500, right? Yes, 500. So you can also do it here. You get it. So yes, now what else? Is there any other? All right, so I think that is all. So yes, so now we've got the value for our current assets. So now we can add all of them to see the total current assets you are getting. So we have inventory to be 22,000. We have trade receivables to be 30,000 minus the 1,500, which is 28,500. Then bank and cash to be 61,965. Then rate and rent advance to be 500. So when we add all of them, 22,000, 28,500, 61,965, and 500, we should be getting 112,965, right? Yes, 112,965. So you can do that here. 112,965. So you can do that on the same line as this one. Let me draw the line so you see what I'm talking about. It can be the same line, signaling that is the total of this part. You get it. So this plus this plus this plus this. This one we closed it, so they'll know that it's not part of it. So yes. So this 112,965 is the value for our total current assets. So now we've got the value for the non-current assets, which is right here, 45,894. And we've got the value for our total current assets. You get it. So now if you want to get the total assets, which is the non-current assets and the current assets, we just add both of them. So when we add it, we are getting the total assets. So our total assets will be, so now our total assets will be the value for the non-current assets, which is 45,894 plus our current assets, which the total we got as 112,965. And we should be getting the value for the total assets. We should be getting 158,859. 158,859. So yes, this is our value for the total assets, which is the non-current assets and the current assets. Now we are done with the assets, both assets. And remember we said the assets is equal to the capital plus liability, and we broke the capital down and the liabilities down. So the assets, which is what you just did, should be equal to the capital. When you said the capital, you add the profits and you subtract the drawings as well. So you just start with, so now our total assets 158,859 should be equal to our capital plus liability. So now we are going to find for capital plus liabilities. Yeah, so our capital plus our liabilities. So we first start with the capital. And was there a value for capital in the question? So for capital, we were given capital in the question as 182,820. So capital was given as 182,820. And that one, you write it at the last column. So you can look at where I'm writing 182,820. Then this is the capital you got. Then you subtract the loss we made. You get it. Now you invested, let's say, 10,000 cedis in a business, and unfortunately you lost 2,000. You have to subtract it because now you are not worth 10,000 again. You have to subtract it. So we subtract the loss. So you can say less loss or less the net loss or something. So when we subtract the loss, so now we're going to subtract the loss from it. The loss was what we did in the income statement, the final value. And when we did that, you remember the value was 17,981. So 17,981. So we subtract it. And we also subtract the drawings. Drawings are what the owner took out of the business for his personal gains. You get it? So if he invested, let's say, 180,820 and took out some money, you have to subtract it. So we say less drawings. You get it? So let me rule the line. So what are the drawings in the question? The drawings in the question was 45,000. So we put it in brackets, signaling that we're about to subtract. So now we have the capital, which is how much you invested in the business, to 182,820. Then you subtract the loss you made, which is the 17,981. Then you also subtract how much the owner took out for the business from his personal gains to be 45,000. So we also subtract that one. So when you subtract, or we should be getting to 182,820 minus 17,981 minus 45,000 should give us 119,839. 119,839. Right, yes. So that's the actual capital or the actual money that the firm has. That's like his personal money. You get it. Now we are left with the liabilities. So it says capital plus liabilities. So we have long-term liabilities and current liabilities as well. You get it. But then in the question, we don't have any long-term liabilities. We only have current liabilities. So what are some of the liabilities we have in the question? You have trade payables. Liabilities are things you are owing. You get it, or what the business is owing. You get it. So trade payables are the amount that you owe to your suppliers. Do you get it? So that one is a liability. So let's first write current. So current liabilities. Then you can just underline it, right? So now the first one is the trade payables. Trade payables is how much you're owing to your suppliers. So yes, the trade payables, which is how much you're owing to our suppliers in the question, is 37,500. So let me just rule a line. So we also do that at the second column. So 37,500. That's under the current liabilities because we have to pay them as soon as possible. So it's current. Then the next one in the question is in the trial balance. They said that they said a bill of 1,520 for vehicle running was outstanding as at 31st December 2024. It means that you've not paid yet. If something is outstanding, it means you've not paid yet. So we write under the current liabilities, vehicle running outstanding. And the value was 1,520. So 1,520. Right? Yes. So I think those are the only liabilities we have. Right? Yes. So when we add the two liabilities, we get our total liability. Since there's no non-current liability or there's no long-term liability, we add only the current liability and that becomes our total liability. So 37,500 plus 1,520 gives us 39,020. So that's the value for our current liabilities, right? So now we said that the total assets or the asset is equal to capital plus liabilities. So our assets has to be equal to our capital, and the capital we subtracted the less loss and the less join. So we got 119,839 as our net capital or our actual capital plus the liabilities, which is 39,020. What that means is that this 158,859, which is our total assets, should be equal to the capital, which is 109,839 plus the liabilities, which is the total liability. So 119,839 plus 39,020 will give you 158,859. So yes, that value becomes our total capital plus liabilities. So our total capital plus liabilities. All right, so you can just rule a line. I see it better. All right, so now realize that when you added the total capital, so the capital is made of the actual capital, what you invested in the business, minus the loss you made in the drawings. So whatever you got, the 109,839. So that's like the actual capital. You get it? Plus the liabilities, which you got as 39,018. So when you added, if you add both of them correctly, you should be getting 158,859, which is the same as the total assets. You get it? So that is the end of the statement of financial position. So this one also gives you 10 marks. I know it's a bit lengthy, but then when you just take your time and solve it, you'll be able to, yes, understand it better. So yes, now we are done with the question one. So that question actually gives you 20 marks. So it's important to take it very serious. All right. Thank you very much for watching this video, and I'll see you in the next video.